There's something shady going on at the Fed, and it's starting to seem more and more like they might be lying to us about the future outlook for interest rates, especially when you consider that inflation just came in higher than expected, and on top of that, they just revised their forecast for both GDP growth and unemployment. And typically when they revise these numbers higher, as they just did, that's usually not a good sign for inflation, and therefore probably not a good sign for interest rates as well. But for some reason, even though the tone has changed with respect to the outlook for the economy, it hasn't changed with respect to the outlook for interest rates, which for some is quite alarming. But before I get into all the details, my name's Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. Okay, so something weird is going on at the Fed, because even though the tone has changed with respect to the GDP outlook and the unemployment outlook and the inflation outlook, the Fed hasn't really changed its tone with respect to how much interest rates are going to come down in 2024. And this is somewhat counterintuitive, because typically when the unemployment outlook starts to look better and the GDP outlook starts to look better, those have inflationary pressures, which is typically an indication that rates are probably going to stay the same or go up, not come down as much as originally expected. So what the heck is going on here? Well, in order to figure that out, we need to take a look at both the news and the data that just came out from the Fed. So let's start with this headline. Federal Reserve still foresees 3 interest rate cuts this year despite a bump in inflation. Now, there's 2 things going on in this headline that are very much counterintuitive. One is we're seeing that there is a bump in inflation, and second, we're seeing that the Fed, even though there's been a bump in inflation, isn't changing their tune with respect to interest rates. And there might be a few reasons why, including the US election, which I'll get to in a minute. But as we dig a little bit deeper into this article, we start to see some things pop out that could be a cause for concern, especially this line. Overall, the forecast suggests that the Fed still expects an unusual combination: a healthy job market and economy in tandem with inflation that continues to cool, just more gradually than they had predicted 3 months ago. Now, this unusual combination line has me worried, because it was an unusual combination of things that led to the Fed believing that inflation back in 2021 and 2022 was just transitory, and that led to the Fed waiting too long to make certain decisions, i.e. interest rates going up, and caused them to have to play a catch-up game that caused interest rates to go up substantially more than they probably had to. I mean, to put this in perspective, interest rates went up in a very short period of time, more than they'd gone up in the 4 years prior to the Great Recession. So it seems odd to me that when the economy is performing better than expected, that we're still looking at interest rate cuts. Interest rate cuts are something that are done typically when the economy is not doing what it's supposed to be doing. In other words, when it's showing signs of a recession. Now, that being said, there is the argument to be made that interest rates went too high and need to come down to get back to normal levels. But when the Fed is revising expectations to suggest that inflation isn't going to come back to that 2% target level as fast as expected, you would think that more time at higher rates would be something that would be expected. But here's the thing, over the last year, the expectations with respect to interest rates have gotten worse and worse and worse. For example, at the end of 2023, it was widely expected that there would be at least 7 interest rate cuts in 2024. Of course, prior to December, that got scaled back to just 4 cuts, and then in December, it got scaled to 3 cuts, and now we're in a situation where the economy is getting better and better, and what should be expected, which is less rate cuts, isn't coming to fruition. But there are some voices on the Federal Reserve they're suggesting that interest rates might not go down as much as expected, which I'll get to in a minute. And even though the market is largely expecting that the first rate cut will come in June, it's not yet a done deal. And with these recent revisions to the forecast for both GDP and unemployment, I would say it is becoming more and more unlikely. And the data is suggesting this as well. Just look at the adjustments to the data here. GDP is now expected to be 2.1% in 2024. What's GDP? Well, that is the expectation with respect to the amount of output in the economy. And on top of that, they've also lowered the expected unemployment rate from December at 4.1% to 4% now, meaning that both GDP growth and unemployment are trending away from a recession. And then take a look at the core inflation numbers. Those have also gone up to 2.6%. But the federal fund rate's projection has stayed the same. Now, when you see the numbers for GDP and unemployment get better, and the numbers for inflation get worse, and the Federal Reserve says we're going to remain on the exact same forecast for interest rates, either they see something in the economy that indicates that they should be lowering interest rates, or they're being very cautious with respect to what they say in order to not create an adverse effect in the economy. So it could very well be that the Fed doesn't want to suggest that they aren't going to cut interest rates as much as expected because they fear that if they do that, it could have an adverse effect on the economy, making everything worse. So what I suspect that they're actually trying to do here is have the conversation in a more gradual way, shifting the forecast in 1 month and then maybe the next month talking about less interest rate cuts and going on from there. The more gradual that expectations are shifted, and the more that they mitigate the risk of a surprise to the economy, the better the potential outcomes will be. And by the way, I'll link to a video at the end of this one that talks about the problems with forecasting and how those conversations are very important when it comes to managing the economy. Again, one of the most powerful tools in the Fed's toolbox, even more powerful than rates themselves, is often the talking points that they have. Now, to take this one step further, let's take a look at the Fed's dot plot. This is a representation of where the Federal Reserve governors stand, specifically with their expectations on interest rates. And what I want to point out here is that there's at least one individual who believes that well into 2025, interest rates are going to need to remain the same. Now, at this point, that is an outlier position. However, the Fed governor that is suggesting that interest rates need to remain high has the exact same access to the data as the rest of the economists. And as we look into 2025 and 2026, we can see that the consensus for what interest rates will look like starts to deviate substantially. And this is where it gets really interesting, because if we take a look at the GDP projections from December versus today, the majority of the Fed governors are now projecting significantly higher GDP growth. I mean, take a look at the December numbers where the majority of the Federal Reserve saw GDP for 2024 in the 1.2 to 1.7% range, and compare that now to the most recent projections, which see most of them seeing GDP growth being substantially higher. In fact, almost the entire Board of Governors of the Federal Reserve has shifted their outlook with respect to GDP. But again, they haven't shifted their expectations with respect to rate reductions. Then take a look at the unemployment data. Again, the dotted line being December's projections and the blue bars being today. Again, the majority of the Federal Reserve is expecting that unemployment is getting substantially better, but no change in the expectations with respect to rate cuts. And then last but not least, take a look at the inflation numbers. In December, the majority of the Federal Reserve saw the numbers in the 2.3 to 2.4% range. Now that has shifted to 2.5 to 2.6 and 2.7 to 2.8, which means there is a consensus that inflation is trending away from that 2% target. But again, no changes in the forecast for rate reductions. Now, it's important to note that these projections are historically wrong. In fact, there is a wide range for the amount of error in them. But the most notable is that there is a 0.9% plus or minus range of error, so a 1.8% range of error for the expectations with respect to short-term interest rates, which means, at least according to the historical average error ranges, that in a worst-case scenario, a 0.75% expectation of cuts in 2024 could actually end up being almost a quarter-point increase. And don't even get me started on the 2- and 3-year ranges for this, because those numbers could be way off. But here's where it gets interesting, because there's quite often an association between the Fed and presidential elections, and more specifically the fact that the Fed typically doesn't do much during election years, at least if they don't have to, in order to avoid altering the results of an election. But as of right now, growth is expected to go up, unemployment is expected to go down, which means the economy is getting better, which is a benefit to Joe Biden, and inflation, at least according to this, is expected to remain flat. But all of that suggests, again, that interest rates should probably be staying the same or going up, not coming down. And I'm going to tell you right now that interest rates are going to play a pivotal role in this election. And in another video in the near future here, I'm going to talk about Republican versus Democratic economics and who historically has managed the economy better. And the answer might surprise you on that. It definitely surprised me. But in this case, interest rates are already becoming an election issue, with Donald Trump suggesting that as soon as the Federal Reserve lowers interest rates, that they're doing it to support Biden, even though the chair of the Federal Reserve is actually a Republican. And vice versa, the exact same argument could be made that if interest rates aren't dropped, that it's being done to support Trump. But it's important to keep in mind here that the Federal Reserve runs independent of the government. In fact, the governors of the Federal Reserve are elected to 14-year terms, specifically so that they can act in a bipartisan manner and that they don't have to worry about losing their jobs based on who gets elected in a presidential election. So the question is the Federal Reserve going to cut rates more than it should in order to help Biden's prospects? Well, the answer to that is probably no. But could lower interest rates help the incumbent? Absolutely, especially if at the exact same time, the economy is performing better than expected, as it is at the moment. But there is at least one Fed governor who is suggesting that there could be as little as one interest rate cut this year. Atlanta Fed President Raphael Bostic is suggesting, and I'm guessing he is the one outlier here who thinks interest rates should remain about where they are through 2024, that there could be as little as one interest rate cut this year, and that the Fed is in a position where it can afford to be patient with interest rates. Bostic said Friday that he now projects just one interest rate cut this year, adding that reduction will likely happen later in the year than previously expected, so not in June. He described the decision to shift his forecast from 2 cuts to 1 as a close call. The goal and the reality is that we've got to let the data guide us. And what Bostic is suggesting, very much correctly here, is that the data isn't suggesting that there's going to warrant 3 interest rate cuts in 2024. So what does this all mean? What does it mean when we put it together and look at the overall picture? Well, the momentum is clearly towards a growing economy, which means that when you consider the fact that in December, GDP was only expected to be 1.4%, and now at a 2.1% expectation, they're saying, well, we still expect there to be 3 rate cuts. That tells me that there's a conscious effort being made not to scare the American people. But that doesn't mean that they won't, in the very near future, change their tone with respect to the interest rate outlook. And my guess is at the next meeting, that will happen, moving from 3 interest rate cuts down to 2. And where we end up by the end of the year is anybody's guess. And while I do believe that there will be interest rate cuts sometime in the future, I'm just not so certain that they will happen right away, which means that as a consumer, we need to be careful about operating as if those interest rate cuts have already happened. In fact, we need to go one step further and operate as if they haven't happened and as if there's still the potential for interest rates to go up further. Because at the end of the day, inflation spikes are almost always surprises. So even though there are forecasts suggesting that over the next year or 2 years or 3 years, interest rates are going to come down, those expectations could literally change overnight. Especially when you consider that yesterday, one of the biggest ports in the US was pretty much taken out of commission for God only knows how long. So it's important to act accordingly and make sure that you aren't doing things like taking on more debt and that you're living within your means. And if you can go one step further and find a way to save more money, even better. Oh, and if this entire video has intrigued you and you want to know more about forecasting and why those forecasts aren't always reliable, make sure you check out this video right here.